Okay, good morning. Welcome back, Principles of Accounting 1. I'm your host, Dr. B. Today we are going to be reviewing chapters 7 and 8. Before we start, I do want to run over a few very quick housekeeping items. First and foremost, under the announcements, I posted, as you know, every week I post a nice, lovely welcome post to welcome you to the week. Talk about what we covered last week, what we're going to cover this week, what you need to do in order to accomplish those goals. Since we are in week 4, which is almost exactly halfway through the semester, I know it's unbelievable. This is an 8-week course, right? So week 4, halfway. So at the end of this week, in addition to your Chapter 7 discussion board and your Chapter 8 quiz, you have the midterm exam. The midterm exam is due by the end of this week. The midterm exam is worth 10% of your total grade. Yes, 10%. It's a lot. It's worth 10 points. So that's 10% of your total grade. The exam covers 20 questions. The questions come from chapters 1 through 8. 1 through 8. So the first half of your book covers questions 1 through 8, or chapters 1 through 8. They are in random order. The exam is not timed. Okay, so don't worry about that. You can start the exam as early as today and all the way through Sunday. Okay, you can save and exit, and come back to the exam. It'll save your responses, right? You can if you click save next to the questions and then save and exit, or click save and close, or whatever it is. You can save your answers and then come back. In other words, you can take breaks. It's open book, open note, open everything, right? So there's no real reason for you not to earn a high score on this exam, okay? So please take advantage of all the PowerPoint presentations, all of the homework assignments, all of the um, uh, recordings, and of course your textbook. All of these will be great resources for you to answer each question. The questions come directly from the textbook. Okay, so there's no like trick questions or anything like that. It's very, very straightforward. So even if you were to search for part of that question in your textbook, it should come up with a response. So get creative with ways to find the answers to these questions. Again, it's not timed. There's 20 questions. You can save and close. You can return to it whenever, but make sure that you submit it by Sunday night. Okay. So today we're going to cover chapter 7 and 8, which are the last two chapters that are covered by this exam. Chapter 7 is super boring. I just want to let you know beforehand that it's really boring. Okay. And then chapter 8 is pretty good. That one's on receivables. Okay, so if you're having any type of trouble with anything, please make sure to contact me right away. You can email me. As you know, I'm very quick to respond to my emails unless I'm sleeping. It might take a few hours, but email me. You can call me. You have my phone number. Okay, that's under faculty information, as you know. Here's my phone number. That's my cell. You can text. Well, I'm not that big on text. My wife really doesn't like it either. So, and of course, the best way if you want to have some private one-on-one counseling time, my office hours are Mondays and Wednesdays from 11 to 3, and you can just go ahead and click on office hours and schedule me, right? This tomorrow, I got plenty of time, so please feel free to schedule some time with me. Okay, great. So by now, just about everyone already has access to the content in the textbook. I think there's like one or maybe two students that are still having trouble with the whole textbook fiasco at your wonderful, terrible bookstore. So just bear with us on that and keep reaching out to them. I know it's a pain. It sucks. I know it does. Unfortunately, that's the way that they set things up this semester. I don't like it. Unfortunately, it's out of my control. If this were stuff in my control, believe me, this probably wouldn't be happening. So, but there it is. Okay, so those are my housekeeping notes. Let's go ahead and jump into Chapter 7. For those of you on the call, for the 9 of you that are on the call, please feel free to stop me, interrupt me, ask your questions as we go along. It makes it fun and entertaining. And of course, I'll ask some questions of you as we are going through the chapters. So let's start with Chapter 7. This is the internal control and cash. Cash is such a fun topic, isn't it? Okay, let's talk about internal controls and cash. So the first thing you need to know about internal controls is the Sarbanes-Oxley Act of 2002. Sarbanes-Oxley Act was designed to provide the public with confidence in the reporting, that it is accurate, clear, transparent reporting provided to the public for publicly traded companies through the Securities Exchange Commission. The idea was to increase trust among publicly traded companies, and that the way that things are being reported. As you know, a good company reports their or a publicly traded company reports their income statement, balance sheet, statement of cash flows, and then they also talk about the operations of their business. And the reason why companies do this that are publicly traded is to attract new investors. And all of this information can be found on the Securities Exchange Commission website at sec.gov. So if you're ever interested in investing in a publicly traded company, that is where you could find all of their information. The Sarbanes-Oxley Act was designed to be a system of internal controls to emphasize a company's internal control process. Internal controls is the process and procedure the companies use to safeguard assets, process information accurately, and ensure compliance with laws and regulations. Safeguarding assets include things like using security cameras over the company's inventory, using security measures to prevent theft within the company, such as the use of cash registers, the use of computerized systems, the use of security cameras, the use of security tags. All of these components help to safeguard assets. And assets also include people. The people, the inventory, the building, the equipment, all of these are assets, right? The cash, obviously cash is an asset, you know that. So things like that safeguard cash, assets. Process information accurately. What this means is that you're entering the transactions into a computer database like a cash register to track the inventory. We talked about that in the previous chapter with tracking inventory, periodic and perpetual, right? To track the information or movement of that inventory, we enter them into a computer database. It's a part of an internal control, right? And of course, ensure compliance with laws and regulations. This means that I am being transparent. I am abiding by the local laws and the local regulations. The Sarbanes-Oxley Act requires companies to maintain effective internal controls over recording transactions and preparing financial statements. So basically, this act, or the Sarbanes-Oxley Act, provides a set of guidelines for companies to utilize while they're publishing their financial statements and all of it's being audited to ensure transparency. The more transparent the company is, the less likely they'll be audited in a negative way. And we could talk a lot about things that have happened in the past. So the reason why Sarbanes-Oxley came about was because of a lot of fraud that was happening by large corporations. Enron, for example, which was an energy company way back when, right, in the 90s and 80s and 70s, and that became a massive company. They perpetrated a fraud by inflating their sales on their books. There was a lot of bad things that happened there. A lot of people went to jail over it, and so the government said, okay, we need to figure out a way to prevent things like that from happening again. And so that's how the Sarbanes-Oxley Act was created, is because there was so much theft that was happening in the past from weak internal controls that negatively affected investors, stockholders, and creditors. So the government said, hey, let's create this act to provide some guidelines for these companies. And so that in turn created better internal controls to help prevent fraud and theft and to protect the investors, stockholders, and creditors. So the Sarbanes-Oxley Act also required independent third-party auditors and accounting companies to validate the financial statements, right? So let's say you're Macy's, for example, and every year or every quarter, you make available your sales reports, your company's financial position, which includes income statement, balance sheet, statement of cash flows. Every year, you've developed the 10K report, which states all of that information for the year. And then you have a third-party company like Deloitte or KPMG or Ernst & Young. Those are large external independent accounting firms. They come in and they audit their financial statements to ensure transparency and accuracy. So this act really, the intention was, we need to protect investors, creditors, and other external stakeholders that are involved in these companies. So that's the Sarbanes-Oxley Act. Let's talk a little bit more about internal controls. So the objective, of course, is to safeguard your assets, provide accurate business information for investors, creditors, and other external parties, and of course, to help employees and managers comply with local laws and regulations. So these are the primary reasons why we have internal controls. So again, safeguarding assets include things like safes for cash, cash registers, security cameras, security tags, you name it, right? We take a lot of measures to protect our assets. Providing accurate information means that our financial statements have been audited by a third party to ensure accuracy and transparency, and that we are in compliance with local laws and regulations. Those are the objectives of internal controls. Let's talk a little bit about fraud. Unfortunately, fraud happens every single day, everywhere, all the time, right? It's terrible. Fraud is the intent of deceiving an employer for personal gain. That's employee fraud. Other types of fraud include things like deceiving investors, deceiving the government, deception, right? That's the whole point. That's what fraud is. It's deception. Deception basically means that you are intentionally hiding a bad act, okay, for your personal gain. That's fraud, right? Fraud is registering for an accounting class without the intention of actually taking the class in order to get a refund. That's fraud, okay? Fraud is putting a credit card skimmer into a gas pump in order to obtain credit card information from your customers. That's fraud, okay? There's so many different types of fraud, unfortunately, but it's important to understand what fraud is in order for you to prevent it from happening to you and to prevent it from happening to your company. And so we go to prevent fraud by implementing internal controls. So let's talk a little bit more about the internal controls that we utilize to prevent fraud. We implement controls within the environment. That is like your security cameras, you create a safe environment for your customers, that is free from slip and fall instances. Like, for example, during the winter, we put salt on the sidewalks. Why do we do that? To prevent somebody from falling and then suing you, right? So that's a part of controlling your environment, right? Risk assessment. Risk assessment is where I look at my business and I identify weak points. What are weak points? A weak point is a way for a fraudster to infiltrate my business. I perform what's called a risk assessment to identify these weak points to prevent that from happening. A weak point might be, let's say you run a gas station. A weak point might be the gas pump itself. Okay, so what do? I assess my gas pumps to look at ways to improve them to prevent fraud. I will replace the magnetic credit card strip readers with an electronic one, okay, to prevent a skimmer from going in there. That's a risk. That's part of risk assessment, right? Control procedures. What this means is that I will not have the same person counting cash that makes the bank deposit, right? So think of a retailer. In the retail setting, we have these cash registers where you go to check out. And so at the beginning and end of every shift, the cashier will count their bank. They'll count the register to ensure that what they're opening with is what they're closing with, and that the difference gets deposited, right? That's a process. There's a process involved there. And so the cashier counts the drawer at the beginning, counts the drawer at the end. Before the beginning of that shift, a manager might be counting that drawer to ensure that indeed that opening roll is the same amount. And at the end of the shift, the manager might validate the fact that the closing of that register has that same amount. And you might have more than one manager that is responsible for bringing the deposits to the bank. There might be a sign-off procedure, right? And all of these people are responsible for controlling the process. And that prevents internal theft.
Oh, Professor, can I say something about that?
Yeah,
That
please.
brings me back to experience that I experienced at working at Wendy's on Nanny Helen Burroughs Avenue. I never forget. I was 19 years old, and I went to the bathroom, and we had a key for the cash register. I left the key in the and I didn't take it with me. It was
Oh,
my
geez.
first time. I didn't know like to take the key with me in the drawer, and my drawer ended up coming up short at the end of my shift. When I tell
Geez.
you, I cried because I told my boss that I did not steal the money. Like I don't steal. I wouldn't steal. You can look at the cameras, but somehow the money was taken from my drawer. So I was upset about that. So I was willing to pay the money. So my boss like don't. She just told me don't never leave my drawer. Take the key with me. Don't never leave it unattended. So
Right.
okay, but then I worked at a Wendy's, and then my drawer come over. It goes over the amount that it's supposed to be. So I'm like, what the hell? I didn't take nobody money. Like I did exactly what my drawer came over. Like it was over the amount that it was supposed to be. So I'm like, damn. I'm like, you damn if your short come up short. You damn if your short come over. So I'm
Yeah.
like, what the hell you supposed to do? Because honestly, it made me never wanted to be a cashier ever again.
It's
I'm
stressful.
being honest. I never wanted to be a cashier no more after that.
Lakeisha, I appreciate you sharing that story with us. And I have very similar ones as well from my experience. And you're right. It makes people not want to be a cashier. Um, and sometimes I think employers go a little bit crazy with it. It's like, okay, well, oh, you're 50 cents off. Oh, you're $1 off. It's like, okay, it's like like, and they'll put it in your file, right? It's like, oh, really? I mean, and I've been written up for stuff like that in previous jobs too. Then they get kind of crazy with that stuff, and so you just have to. I mean, the point of the process is to obviously control the assets, and I understand that, and and you understand that, but it's just sometimes employers take it a little far.
Yes, they do. Yes, they do.
But good story. I appreciate you bringing that up. Next one we'll talk about is monitoring. Monitoring is doing like spot checks. So like a manager will come to your cash register, open it up, and kind of verify the receipts, right? Or they'll of course cameras are part of monitoring, but they'll do spot checks, right, to make sure. Oh, they'll count the inventory, make sure it's still there, right? And they'll match it against the receipt from the register. That's monitoring. That's another process of control. And then information and communication. What does this mean? So oftentimes businesses control the way that they talk to the media. They will control the way that they release information to employees. Everything is very uniform, controlled, and is clear, right? They try to make sure that everything's clear. That's information and communication. And there's a lot more that goes behind it, of course, but those are just some examples. Okay, so why do we do all this? We try to limit the threats. It is impossible in business to control all threats. It's absolutely impossible, okay? You're never going to get to a point where you're able to control threats because it's going to happen, right? Somebody's going to steal from you. Some external factor will influence your business. There are things you cannot control, but there are things that you can control. And so we're talking about the things we can control, right? We can control our environment. I can prevent people from tripping and falling. I can control the flow of cash in the business. I can assess the risk. I can control the procedures. I can control the monitoring aspect. That's stuff I can control. I cannot control a
Take him to
virus,
really
right?
explain to him what we up here.
What was that, Fritza?
Oh, I'm sorry. My son was misbehaving in class, and I had to let him know that's intolerable. I apologize.
That's okay. That's one of the threats you got to manage. No worries. So the point is that you can control aspects that you can control, but there are things outside of your control that you cannot, that will have an impact on your business, like what we're going through right now with this COVID-19. It's having a negative impact on all of us, but it's also having a severe negative impact on our businesses. And so that's something we cannot that's out of our control. That's an external threat. The internal threats I can control, like I can control my employees, I can control my cash, I can control my inventory, I can control other assets of the company, but I cannot control external threats like a virus or a downturn in the economy or whatever, right? So that's just kind of how this is illustrated. And of course, within that control, I can inform and communicate clearly. And of course, management can overlook the documents and so forth and so on. So controlling your environment, it's all a matter of how your employees perceive information that's being controlled. So there's really three factors of influencing or a company's controlling the environment: the philosophy of how they do it, the organizational structure of the business, and the personnel policies. Philosophy is This is how I plan to control my business. That's what philosophy is. The organizational structure, this is how the business is structured. We have the CEO at the top. Just below the CEO, we have vice presidents. Just below the vice presidents, we have department managers. Below the department managers, we have the employees. And then, of course, then we have customers, right? That's our organizational structure. That's the framework of the business. So things in most businesses are top down. That means that all of the direction comes from the CEO, and the CEO dictates everything that happens in that business. And the CEO communicates to the vice presidents communicate to the other managers communicate to the employees, so forth and so on. That's top down. Sometimes an organization is top or bottom up. That's where the employees are the ones that help to influence the development of policies and procedures, and then it goes to the top, right? And of course, companies' personnel policies. This includes things like hiring, training, evaluation, payment to employees, promotion of employees, so forth and so on. These are the controls of personnel within the business. Personnel, those are employees of the business. This is how it looks. CEO dictates organizational structure, which are made up of the employees, and the employees are the ones that create policy, so forth and so on. Risk assessment. How do I assess risk in a business? I look at all the external factors. I look at competition as a risk assessment. Competition, as you know, those are your competitors, right? Like if you're Wendy's, your competitor is McDonald's and Burger King, right? And of course, and Chick-fil-A, I guess, or whoever else. Changes in your customers' preferences, that's a risk. So if your customer's preference changes, you would need to change as well. Regulatory changes. The government changes laws every so often, so those are things that I need to know and be aware of so I can then adjust my policies accordingly. Changes in economic factors. When there's a downturn in the economy, I need to strategically pivot my business. So what you're seeing right now is a great example. Because of the COVID-19, people are not going to grocery stores as much. They're not going out to eat as much. They're not going to do their daily shopping. So what are the businesses doing in order to mitigate that risk? They're moving online. They're figuring out new ways to be creative to get you the goods and services that you want. So what are they doing? They're moving online. They are now offering short time delivery. You can pick it up outside of the store without having to go inside. They're dropping it off at your door, right? Touchless contact. The businesses are pivoting in today's environment in order to adjust to the downturn in the economy due to other threats. So this is called risk assessment. So management identifies these risks, they analyze the significance, and then they make adjustments accordingly to mitigate that risk. Control procedures. We identify a set of procedures to help prevent fraud. That's what a control procedure is. There are a couple of steps here things that include controlling procedures. We control personnel. We rotate duties. We implement mandatory vacation sometimes in certain businesses. We rotate personnel in order to keep things fresh and keep things moving and to properly keep our employees well trained. We separate responsibilities for related items. For example, in an accounting part of a business, I might have 2 or more people doing the accounting work. I might have one person taking care of the accounts payable That's the person paying the bills. I might have a different person taking care of accounts receivable. That's receiving payment from your customers. Okay? These are two different people, two different positions. I keep those two separate because that is a way of me controlling the process. And then I'll have a third person taking care of payroll, right? So if you have those processes separated, those responsibilities separated, it reduces the risk of error and fraud. Separating operations from custody of assets and accounting. So the process by which things are checked, the checks and balances, right? You've placed an order from Amazon. You received your package. Inside that package is a packing slip. You compare that packing slip to your bill, to what you actually received. Okay? If all three match, perfect, wonderful. If there's a discrepancy, then we have to go through that process of managing discrepancies. So, but that is a process of custody of assets, right? Proof and security measures. Again, the use of cameras, cash in the register or safe, things like that. And here's a nice visual representation. What about monitoring? Monitoring, I use, again, security cameras. I identify changes and behaviors of my employees. I look at my accounting information system, my QuickBooks or my Peachtree or whatever the company is using to identify potential issues. So basically what I'm looking for is I look at changes. I look at small changes within somebody's behavior or within the books to identify a potential problem. Okay, so like for example, let's say I do the same thing with students, right? Let's say I have a wonderful student. She does all of her work, but then all of a sudden, she didn't do any work last week. It's like, okay, that's a change in behavior. That there could be a problem there. So then I'll reach out to the student and say, hey, is everything okay? I realize you didn't do your work. How can I help you, right? So I'm monitoring the student's performance and their behavior. So then I can go in and mitigate the risk, right? I'm mitigating the risk of the student potentially failing. So I reach out to my students when I realize that they're missing something or they're falling behind, because I don't want you to fail the course. So I monitor your behavior over time. And when I realize that there's a potential risk, I reach out to you and say, hey, is everything okay? How can I help you? This is what you're missing. Let's get that in so that way you don't fail, right? That's the idea. So I'm monitoring your behavior. And the same idea works in business, right? I monitor the behavior of my employees. I monitor the accounting system to see if there's any potential changes. If I see a change, then I can quickly identify that change and make adjustments accordingly. That's the process of monitoring within the internal controls of business. So again, you're looking for warning signs within people and within the accounting systems. And here's a couple of examples that are listed down. Information and communication. Managers should be responsible for providing reasonable assurance in their reporting, legal and regulatory, by meeting legal and regulatory requirements. Everything should be clear and transparent. Management should also be using clear and transparent communications with their employees and with other external parties. What are limitations of internal control processes? I can only take my internal control processes so far. I try my best to do the best that I can, but I'm limited to some degree. The human behavior is a limitation. Cost-benefit considerations is a limitation. For example, I want this great security system for my business. I want these wonderful cameras. I want this wonderful computer system. It might be very expensive. So I need to weigh the pros and cons. What is the cost benefit, right? So these are things that could be potential limitations for internal controls. Let's talk about cash. We spent so much time on internal controls. We talked about Sarbanes-Oxley and all that great stuff. Let's talk about one of my favorite things: cash, cash money, money, cash, cash money. Cash includes things like paper money, coins, currency. That includes things like check, and it also includes things like money orders. Another thing that cash, and people don't think about this for some reason, I don't know why. But let's say you pay your bill online, okay? You pay your bill online. Is it cash? What do you think? Who can answer this question? Is it cash? If you pay your bill online, is it cash? Are you using cash?
It depends what kind of method of payment you're using. If you're using a credit card, then it's credit. But if you're using a debit card, then it's cash.
That's a good answer. I like that answer. Yeah, you're absolutely right. From a personal perspective, yes, that is correct. That's absolutely right. From a business perspective, cash can also include credit cards. Cash is cash. It's how you're paying for it, right? It's paper money, it's checks, it's money orders, it's electronic payment. These are all cash. Yeah, very good. Excellent job, Fritza. Money on deposit with a bank, tuition available for withdrawal, we consider that cash. Anything you could easily access is cash, right? From your bank is cash. Cash is an asset, as you know. It's also the most vulnerable asset. Cash is very vulnerable. It can be stolen or it can be improperly used within a business. Improper use, what's an example of that? Let's say I took cash out of the cash register to go to lunch. That's improper use of cash funds, okay? You shouldn't be doing that. Okay, so how do we control cash? We use receipts, of course. To protect cash from theft or misuse, we use cameras, we use receipts, we use time to control cash. Typically, I'm receiving cash from my customers from a purchase that they've made or a purchase that they made on account. As you know, accounts receivable means that a customer purchased a good from me, but they have not yet paid me, so therefore I create an accounts receivable. When the customer then pays me with the cash, I reduce the accounts receivable, but cash is still utilized in this process. So when I'm receiving cash, I need to control it. How do I control it? I match the cash with the receipt. It's important to control and protect cash received over the counter in the sales register. How do I do that? Customer purchases their goods from my store. They give me cash. I give the customer a receipt. Receipt. Okay.
Yes, I have a question. Whenever you're done this slide.
I'm sorry?
I said I have a question. One of the questions I have is how important it is to keep the invoices and or receipts after when you have to I guess put it within the books or
It's
when we do
critical.
audits.
It's very, very important that you do that. So looking at this slide, from the register, goes to the receipts, goes to the accounting department. What you're talking about is right here, this receipts. From the register to the receipts to the accounting department. It's very important that you keep all of your invoices and receipts. You want to keep it for 10 years. Okay, 10 years. Why 10 years? So 7 to 10 years really, but 10 years is best. You want to keep your receipts and your invoices for about 10 years. The reason being is because if you ever get audited by the IRS or by some other government agency or by some other external person, they want to see your receipts. Because what they're doing is they're going to look at your income statement, right? Your income statement is going to show your revenues and your expenses. Your revenues and expenses are going to be tied to those receipts, okay? The receipts tie to your revenue and expenses on your income statement. An auditor from the IRS or from somebody, right, or an external person wants to see those journal entries, they're going to match the journal entries to the receipts. Why are they doing this? This is what we call the matching principle in accounting, okay? They're matching the transactions to the receipts, and they're following the cash, okay? It's what we call a paper trail, right? And it's super important to have a paper trail because if you ever get audited, you can show exactly what happened. This is exactly where the cash went, okay? And then if there's not a receipt or an invoice, there's a problem, okay? Or a potential for a problem. If there's not a receipt, but the cash is gone, where'd the cash go? Was it stolen? Was it a part of a misappropriation? What happened to it? And that's what the auditors are interested in. They're looking for anomalies. An anomaly is something that's out of place. An anomaly could be a missing receipt, a missing invoice, some type of something happened. Okay, maybe you just lost the receipt. Okay, that happens, right? But how did you account for the journal entry? If the receipt's gone, how did you account for the journal entry? And then that brings me to the bank, right? The bank has a list of all of the transactions, right? And so our cash that gets deposited goes into the bank. The bank issues what you call a bank statement. On your bank statement, lists out all the transactions, okay? You match the transactions from the bank statement. You match that to what you have in your accounting system. We call that process bank reconciliation, and that we're going to talk about that here in the next slides. Fritza, does that help answer your question?
Yes, it also helped answer. This is when I first got my first managerial position, and I got written up. I was like maybe 22 years old, and I was in Texas, and the manager pulled out some petty cash for me to go buy something. And I came back and I forgot the receipt, and it was very busy. He didn't give me a harsh mark. It was just a warning, but to me, I took it as a write-up. But he was saying how critical it was. But to me, I was thinking, like, it doesn't matter. This product pays for itself because how much we're selling it for. But I was just naive to the thought of not understanding what business is.
Sure. No, thank you for sharing that story with us too, because that really helps to put things into perspective. Yeah, absolutely. Thank you. Okay, so let's talk a little bit more about the cash process. So salespeople make errors. They might charge customers too much or not charge them enough or whatever. As a result, the amount of cash on hand might be different from the cash sales. This different, we call it an over or an under, or over or short, right? So like, and this goes back to what Lakeisha was telling us earlier about her experience with her drawer being over or short. So what happens is that when your drawer is over, that means you didn't give the customer proper change. Okay, so let's say my sale came up to $9.90. I gave you a $10 bill. You didn't give me any change. Your drawer, your cash drawer, is going to be over by 10 cents. Okay, it's minor, yeah, it's minor, but it makes a difference, right? Because we still have to account for that 10 cents. In accounting, it doesn't matter if it's a penny or $1 million. Okay, every penny needs to be accounted for. Those pennies add up, and those cause major differences in business. Okay, so that in accounting, when you reconcile your drawer and you're entering your transactions into your accounting system, there's going to be a line item. It's called the cash short and over account, and it's one of those adjusting journal entries that we make. So here's an example of it. let's say the cash register for cash sales for May 3rd totaled $35,690. However, the cash receipts from the cash sales totaled $35,668. Okay, so we're short by $22. The cash sales receipts and shortage would be recorded as following. I debit cash to show that I took in $35,668 in cash. My sales, I credited my sales $35,690. So the difference is $22, and I'm short by $22. So it'd be cash short and over $22. If I'm short cash, I debit the cash short and over. I debit when I'm short cash. I credit that same account if I'm over. I debit cash short and over if I'm under, and I credit cash short and over if I'm over. Okay, it's very important. Okay, if there's a shortage, cash short and over is debited. If there's overage, it's credited. At the end of the accounting period, a debit balance short and over is included in miscellaneous expense on the income statement. Alternatively, it would be a credit to other income if it's over. Cash is received in the mail when customers pay their bills. Well, shoot, I hope not. You should never be mailing physical cash, people. Please don't do that ever. A check is fine. A money order is fine to mail. Never mail physical cash. Never do that. That's insane. I'm not going to put physical cash in an envelope and mail it. That will be stolen, I guarantee it. So please don't do that. Cash, more like checks or money orders, are received in the mail when customers pay their bills. This cash is usually in the form of checks or money orders. It should never be in cash. Most companies design their invoices so that customers can return a portion of the invoice, called a remittance advice. So, do I have my water bill? I think I do. I just got it. Anyway, where's my water bill? I'll show you. I paid it online, but I'm going to show you what it looks like. Well, I mean, all of you have probably seen a bill by now, I would hope. Okay, here's my water bill. Here's my water bill. Oh, you probably can't see it that well. So at the bottom of my water bill, it's because of the background image. I have a water bill, okay? At the bottom of my water bill, it says, return this portion with your payment. So you write your check, you put in the amount on that little piece of paper at the bottom of your bill. You tear that part off and you put it in the envelope with your check. When you do that, it's called a remittance advice. That's what that little bottom piece of the statement of the bill is, okay? And it usually has your account number, your address, and the amount owed. That part of information, when you send that in with your payment, it helps to control the cash being received for the company, okay? Because the company's getting hundreds of these bills in the mail, right? They send out all the bills, the thousands of bills. Every day they get hundreds back in. When they get it back in, it's with a check and with that remittance advice. It helps the company to control that cash. And also on your check, when you mail your check in with that bottom part of your bill, I like to write the account number on it. So that way it helps the control process, right? For me and for the company. I always like pointing that out. I mean, these days it's all done online through what we call electronic funds transfer, or EFT. This is where the customer goes and pays their bill online, through the website, over the phone, through their cell phone, whatever, right? Electronic. Anything electronic. We call it electronic funds transfer. So I typically pay all my bills online. It's very rare that I write a check these days. It's unlike my mom. My mom, on the other hand, she does everything by check. She is afraid to use a debit card because she doesn't know what it is or what it does. I keep trying to explain to her, "Mom, it's safe. It's just like cash." No, 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 because her reason is I won't know where my cash went. Right? So and that's okay. It's it's all right to be afraid of electronic funds. It's normal, especially for generations that are a little bit older. Before computers, right? And so over the years, you get used to it and you start adapting it, right? But the idea is that any electronic exchange of funds online or anything electronically, we call it electronic funds transfer. And usually on your bank statement, it'll show up as EFT, electronic funds transfer. Companies like using EFT because they are able to receive cash a lot faster than through the mail. It costs a lot less, so it's quicker, costs less, and it usually an employee doesn't have to touch any physical check or something like that. So it just makes life easier for everyone. Controlling cash payments. Payments are made only for authorized transactions. Cash is used effectively and efficiently by controlling the process and discounts. Now let's talk about vouchers. A little bit different, but similar. A voucher system is a process of authorizing and recording liabilities for cash payments that are either manual or entered in a computer. A voucher serves as the authority to pay cash and electronic funds transfer. Okay, the process is super similar to like petty cash. Fritza brought up petty cash, right? So and I'm getting there. I'm going a little bit faster because some of this stuff is just kind of self-explanatory. Where is the petty cash? I think it's toward the end. Oh yeah, so petty cash toward the end. Petty cash is something that, let's say you're working at a hotel at a front desk, and your hotel has a shuttle service to and from the airport. Your guest missed the shuttle service and took a cab to the airport. You might use petty cash out of your drawer to pay for that guest's cab fare. Okay, and you'll get a receipt from the cab company. You'll put the receipt in your cash tray to represent that the cash went out, right? So that's just something I wanted to bring up because it's really falls more along the lines with the vouchers. Bank accounts, I really don't need to talk too much about that. I do want to talk about bank statements. Bank statements are something that is either mailed to you or available online. These days, it's almost all online. The bank statements has all additions, deductions, and it provides your ending balance, beginning and ending balance. It looks just like this. All of your transactions are listed out. Deposits are usually on top, and then withdrawals are on the bottom. And everything has a date, when the transaction took place, all that good stuff. The reason why we have bank statements in accounting is very important. We take the bank statements and we reconcile the bank statements. What do I mean? Where is my reconciliation? Bank reconciliation. A bank reconciliation is where we take the bank statement and compare it to our ledger, our accounting ledger, right? And so what we're doing is we are matching the transactions from the bank statement to the accounting ledger to validate that that transaction has taken place and that what I am showing for cash on my ledger matches the cash balance on my bank statement. Does it make sense? Good?
Yes.
Wonderful. Awesome. It's very important that at the end of each month or the end of each quarter, you do this bank reconciliation process. In your accounting system, you match it to the bank statements to validate that your balances are in line with your bank statements. And of course, there's the reconciliation process for adjustments, should they ever be needed. And here's a list of steps for the reconciliation process. Okay. Talked a little bit about petty cash. Oh, let's talk about this one. Special purpose funds. Sometimes companies will use an account called a special purpose fund. It's often used when cash funds are used for special needs, such as payroll or travel expenses. It's rare. It very rarely happens. But sometimes the business might be short on cash, right? And so they then need to allocate cash that was used for something else to pay for payroll or for travel expenses. So when that happens, we repurpose that cash and we call it special purpose funds. It's rare, but it does happen. We also have this thing called. Go ahead, Fritz.
So with the special purpose funds, can that be correlated for let's just say a manager paid for an employee's Uber ride or Lyft ride to work? Does that fall under that? Is that something?
Yeah, absolutely. Yep, it would fall under that for sure. Sometimes it might just be called, it just might come out of the petty cash fund, which sometimes happens as well. But most of the time, if an employer's paying for an employee's Uber ride, because obviously there's not physical cash changing hands, we would use a special purpose fund, and it's through through an EFT. But yeah, good point. Talking about cash equivalents. Companies may have temporary access in cash. The company normally invests high liquid investments in order to earn interest. If the purpose of an investment that a company has is to increase its interest income, we call that cash equivalents. These would include things like treasury bonds and notes or money market funds. It's really not as common, though. It's really not as common. For larger corporations, it's kind of common because businesses that have a lot of cash on hand, instead of just letting that sit in the bank, they might invest that cash to earn interest. And when a company earns interest, they're basically earning additional revenue, right? Okay. Okay, here's an important one that I want you to know. Days cash on hand. It's a formula, but it's an easy formula. Days cash on hand tells us how long a company could survive if its sources of revenue were to decline significantly. In this example, I like to think about Sears because this is what happened to Sears. To figure out how long the company could survive, we take the cash on hand and any short-term investments, if there are any. We divide that by the daily cash of operating expenses. Basically, what this formula tells me is how long a company can survive. The cash and short-term investments are taken from a year-end balance sheet to represent the most liquid assets. And of course, the daily cash operating expenses are computed by taking your operating expenses, subtracting out depreciation, and divide by 365. That tells me the daily cash operating expenses. And again, this formula basically tells me how long the company can survive, if they were no longer to get any additional income. The following information for eBay. year 1, year 2, year 3. You see your cash, short-term investments, operating expenses, and depreciation expenses. You take your cash plus your short-term investments, and we divide that by your operating expenses minus depreciation to get you your number of days outstanding. Divide by 365, of course. Okay.
What banks use to determine if they will loan you money?
Yeah, for business, yeah. So that's one of the determining factors. They'll look at that to get an idea of if they should loan the business cash, right, for operations. Because if you could prove that, hey, we have good sales, but we're low on cash, they would run that computation. Yeah, absolutely. It's one of the things that they would take into consideration. Good question. Are there any other questions for Chapter 7? We're good so far? Okay, great. So that's Chapter 7. I'm going to briefly stop the recording, and I'll resume the recording for Chapter 8. I like to break them up into segments, Otherwise, it's like a 2-hour recording. Nobody wants to sit through that. All right. I'm going to stop the recording now, and then I'll start the next one.